you can white knuckle a goal. And goals are great for people that want one-time success. But systems are those that are important for people that want predictable and repeatable success.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 348. When I started investing in multifamily, it was 2008. And every property was a distressed property. The period between 2008 and 2012 was definitely a buyer's market, and sellers were desperate to unload their distressed and non-performing properties. As the market shifts once again, it seems like we're heading into some sort of recession. So it's a good opportunity to discuss the outlook on distressed commercial real estate and how you might find the best opportunities currently available. Jake Harris is our guest today, and he is the author of Catching Knives, a guide to investing in distressed commercial real estate. So he's the perfect person to have this conversation with. Jake, welcome to the show.
Thank you very much, Brian. I appreciate it.
Tell us a little bit about yourself. What's your background and how'd you get started investing in real estate?
So 20 years ago, I read a book probably very similar to many investors, was the Rich Dad, Poor Dad book. I was getting out of the Army and was trying to figure out what I wanted to do when I grew up. So I read that book, and not to say that it is super technical, but it just kind of like opened up a new realm of possibility to my mind. And it was like, that's what I wanted to do. So I didn't know how to do that. It took me a few years until I got into real estate. And then I had established a goal of becoming a millionaire before 30. And so this is 20 years ago, early 2000s, that I started investing, and then rode a very significant market uptick and was like, I'm a genius and I achieved my goal. And then, like you said, a very, very sad, horrific crash down when everything was in distress. And I was sitting on a street corner crying to be worth no money because I had a negative net worth. I was hemorrhaging money and had, owed more than the properties were worth and negative cash flow on those. And so I very much lived the experience of what happens when there's a market correction. And then subsequently, I retooled and figured out what I did well, what I did poorly or wrong, and started developing some of these systems and started investing back really in 2009. The quote I used on the back of the book was, the best time to buy is when there's blood in the streets, even if the blood is your own. And so subsequently, it was my blood that was in the streets. It was me losing all that money, but that actually marketed a good time to be investing. And so, subsequently, I've done, 1,400, properties in 23 states. We've sold some of those off to big institutional investors and single family rental portfolios and some commercial deals across the different platforms. I wrote that book, like you mentioned, in 2020, because I was like, yay, it's my time. It's going to happen. Like, this is what I'm really good at. And then real estate values tripled. The government went and printed $20 trillion. And so, however, to your point, it seems like we're in a recession, a technical recession. What does that mean? Is there going to be opportunities? And that's something I'm sure that we can dive into more detail on in the show.
Jake, going back to 2008 to that 2009 period where you kind of lost everything, you had negative net worth. What were you investing in at the time? And what were the one or two or three pivotal decisions you made to be able to pick yourself up and brush yourself off and get back in the game?
Some of the key points of failure was over leverage, was in residential, properties, rentals. The market corrected, and really there was a much different fundamental. They were building, and I was down in Phoenix at the time, they'd been overbuilding the market pretty substantially because people were buying 2, 3, 4, 5, 8, 10 houses, properties at a time. People that were speculating on the appreciation, not necessarily as found sound fundamentals of rental properties. Even so, properties that were, cash flowing for me, because that market fell out, the rental rates also just subsequently just crashed. I mean, you could rent a house for, $2,000 a month or $1,500 a month. And then because there was just this glut of inventory and the prices were falling, there was abundance of rental units, and it was all of a sudden $1,000 a month or $800 a month you could rent a house for. And so that's where I had my payment and then the negative cash flow on these properties, or just oftentimes no renters at all, and proved to be very problematic.
What did you do then? How did you pick yourself back up?
I sat down there and I said, to me, it was another book that I actually read. And there used to be these things called bookstores where they'd actually have stores full of books that were not the library. And I'd walk over to the bookstore and there was this new release on the time, and it was The 4-Hour Workweek by Tim Ferriss. And so I would walk over and I'd read it in the lobby or kind of the coffee area of the bookstore, and I put it back. And for, I'll give you the condensed version for the people that don't know it, or the 4 or 5 people. It's not about working 4 hours in a work week. Is how do you 10x what you're doing? And so what I did was I realized that I am going to be in real estate for the rest of my life. So I said, okay, what did I do well? And I started looking at how did I spend more time and focus and efforts on the things that I did well, and then obviously hand off or assemble a team or do things that I didn't do well. Fortunately, I was able to go do the grunt work, the sweat equity of what we called a rich guy. A rich guy, now they're called family offices, but a guy that was a home builder, had built several 10,000 homes and sold his company to Lennar, had hundreds of millions of dollars. He was the money. He was the one that was funding it, and he needed someone that knew how to buy things properly. And so that was one of my superpowers, is that I'm persistent, I'm very analytical, and can do a lot of due diligence. And so we put together an opportunistic purchasing entity. And so he funded it. So I didn't have the credit or the capabilities, but he had the money, but he didn't have the time. I now had the time. And so we combined that is to start doing and creating a kind of a win-win scenario. That allowed me to get kind of back up on my feet, start investing into more of my own deals. He was keeping the lion's share of all of that. And, I was just kind of working for him. And so then, in time, I was able to kind of incrementally grow. And so I talk about this so my, goal was to be a millionaire before 30. I achieved that goal. And then where I also found some of my downfall or pitfall was being lazy. And once I achieved that goal, I kind of took off the gas pedal. I was like, yay, I'm a millionaire, whoopee. And the reality is that everyone defaults to the level of their systems. And if you've read the book Atomic Habits by James Clear, it kind of really crystallizes that for me. And that was what I also kind of realized in this downfall and this introspective time period is you can white knuckle a goal. And goals are great for people that want one-time success. But systems are those that are important for people that want predictable and repeatable success. And because you're going to default to the level of your systems, and to give you an illustration of this is you oftentimes see people lose weight. I want to lose weight. I want to lose 20 pounds. And they do. And then subsequently they put on 25 pounds because they didn't change the systems in which they're operating on. So mine happened to be, I wanted to be a millionaire. And I was able to white knuckle and put in the hard work and be very, very myopically focused on achieving that goal. But then when I let off and I stopped, it was not sustainable. I did not have systems that were producing the results in which I needed to maintain that and evolve it and continue to grow it. So that's the big thing that I learned from this was develop systems, especially that where you're lacking, or give you the capabilities to put in team members or automation or delegation or something in that, and then also allow you to stay in your superpower strength. So like whatever you're good at, mine happened to be the analytical kind of research. So it was like, that's what I was good at. I like doing that. It's easy for me to do those things. The other areas, I'm not good at those. So how can I assemble a team or put a system together? And that has then subsequently allowed me to grow and scale across the country.
Since we're talking about systems and we're talking about distressed commercial real estate, let's combine the two. What are the systems you have in place to carry out your investments in distressed commercial real estate?
It's doing your homework before that time happens. You are going to have imperfect data in distressed investing. And so when I say that is, you oftentimes are not going to have complete OMs. You're not going to have, rent analysis, cash flows. And sometimes it's just these people are distressed. They just want to get rid of it. And so understanding due diligence and starting to do that ahead of time. And if that is market, if you're looking at a particular market that you like the fundamentals of, getting rents and comps, comparable properties in the area. And so what happens is when that distressed asset does come available to you, you already have assembled your information. You can move quickly and oftentimes structure a better deal for you. Again, I don't see real estate having a massive glut of distress just because it historically fares pretty well in high inflationary environments. But even in a growing economy and a growing inflationary environment, there are people that do have distress. And so the people that are prepared for that oftentimes can make that fantastic deal. And so the deal of a century or the deal of the decade happens about every other week, if you're really diving into the details on that. And it's the people that have the fortitude, the ability to move quickly when there's imperfect information, oftentimes that structure and create the best deal. But, and obviously to the title of the book, Catching Knives, is you could have a devaluation of that asset, but that may not be your business plan. Your business plan is to hold it for 5 years or 10 years or 100 years or never sell it. And so then it becomes less important on what the value is today and then what you're executing to your business plan. So that's another one of those systems is how do you develop your business plan? How do you develop what is the strategy that you're going through? I'm sure you've heard this. People come in and say, I want a good deal. And I'm like, well, I don't know what that means to you. A good deal for me may be a terrible deal for Brian, or Brian's deal may be terrible for me. And so it's like you need to unpack and get a better defined definition of what your business plan is. And if your business plan is to quickly turn an asset or to buy a note or to buy a non-performing note, all of those have different business strategies and different due diligence and research that you need to be doing before you actually even look at any deals. That's what I think is the big foundational understanding, especially in distress, is understand what market value is so that you're getting a good deal when you can buy it. And then that'll also give you the ability to move quickly.
You mentioned that the deal of the century happens every other week. Take us through a recent deal of the century that you were able to see through. Help us track. What was it? Where was it? How did you take it down?
I was like, they're not all my deals. The deals of the century are not all my deals. I think those are sometimes the other people, but they happen to be in the right space, the right time. And you just see that and you're like, oh my gosh, what an amazing deal. I'll give you an example. And to this point was an industrial property that the seller was closing down their business. They were occupying the industrial property. And so it was going to be a highly vacant property. And through off-market, kind of marketing, reaching out to them, the seller just wanted to get rid of it. They're closing down their business. They weren't even selling their business. They're just simply closing down their building. And so they said, hey, I'll sell it for this. It'll be for $7 million. Well, based on the size of that asset and the industrial building is current rents, and what our assumptions were on those rents is that if it was full, it would be worth significantly more money. But as an empty building, he was correct. It was not worth a whole lot of money because you're buying the cash flow. And so in order to, do that transaction, we're able to get control of the property, to do some marketing, to see if the assumptions of the rents were accurate. So one, control the property, come together. Also looked at an exit partner, so got a forward commitment from a private equity group, kind of a REIT that was looking at, hey, if you have more than 5 years on a lease term with, this type of credit tenant, we'll pay a 6 cap or a 5.5 cap. I don't remember what the actual, numbers were. And so based on that and the square footage and what we assumed the rents were, we'd like, means that's worth $20 million. That building is worth $20 million if it's occupied. We were, and then you can put that out and you can test that market. There was tremendous amounts of demand at that price point. And then it was then a question of how much does that tenant need in a TI to sign a long-term 5, 7, 10-year lease. And then, was able to kind of vet that out again while in escrow. Taking that in escrow, they needed about $3 million to build out the site, to get better loading, better exiting, some upgrades and some additional equipment, but they'd then be willing to sign a 10-year lease. So that's a $3 million. So you're looking at $6 million purchase, $3 million TI. So $10 million into it and a $20 million forward commit as an exit. And so then that becomes very easy to finance as well when you go to the bank and say, hey, I need 50% of the future's value, and here's the tenant and their credit worthiness, and they can come in and you can go do this deal for little to no money. And then, in the completion of that, which is still kind of in process, it's an infinite return, only have to bring in a small amount of money, and subsequently may just decide to keep it for cash flow.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com.
Tell us why you decided to write this book and share these stories and examples of distressed commercial real estate with other people.
I think distressed investing, and obviously in the book itself, it's not exclusive to distressed investing. It is some of the fundamentals in which making sound investment decisions, assembling your team. You don't have to know everything. I have been a professional investor for 20 years. I have a master's degree in international real estate and finance. I have a broker's license. I've done, thousands of transactions and hundreds of millions of them. And I am not in any way the smartest person or most experienced person in real estate. And so every single day I find new ways in which things are very successfully done, different ways of doing it. And I don't try to collectively be the smartest person in the deal. I hate reading leases. Just not my thing. But I have real estate attorneys that are fantastic at that and can get into the details of those. So it's like, again, figuring out like where your strengths are. The book has and blocks out. There's some key people on your team that you should have available to you as far as your contractor, your attorney, your brokers, your leasing team, your debt partners. All of those are important, and you may have skill sets in those. And if you don't, then how can you look at supplementing your team to get those people added? And then they don't all cost money. So that's the other thing that we're talking about is the fundamentals of a broker that's helping you buy a deal doesn't cost you money up front. A contractor oftentimes wants work, and so they're willing to help you do analysis on a building or take a look at that it doesn't necessarily cost you. You may not have the balance sheet. You may not have the investment capital. You may just need, like in my situation, was somebody needed to go do the work. You could partner with someone that had more money than they had time. It allows you to identify the things that you have or you're good at, and then how you subsequently build out your team. And then there's some tips and tricks and tactics and things to look at. There's a lot of ways in which you can get really, really over the tips of your skis. That metaphor and some examples I use in there is you can buy contaminated land or dirt that is hugely problematic. I mean, you can get something for free that'll end up costing you millions of dollars. So there are certain things that you should still need to do, especially in the commercial real estate world. It is buyer beware. It is a shark eat shark kind of world. It is you can't unwind these deals oftentimes. And so you need to make sure you understand what you're getting into. So that's why I particularly like distressed investing, is because it allows me to structure the deal that is ultimately a win out of the gate. You always make your money on the buy. I see a lot of people, and more recently over the last couple of years, is they're speculating on future growth. They're speculating on rates staying low for a long period of time, or rent growth going at very high levels, and they're not buying a good deal today. They hope it's going to be a good deal in the few years in the future. And again, that's my own experience of doing those same things, watching the market correct and the music stop and being left there holding the bag. And so I underwrite a lot more conservatively because of that. And I like a distressed environment when everyone else is scared of something. There's good opportunities when other people are scared.
How are you finding your distressed commercial opportunities right now?
It's, very limited, the amount of distress that's in the market right now. We're still buying, but they're, on market deals. They're not necessarily highly distressed. But again, people do have distress situations. And it's a combination of several things. And so that's what we kind of talk about in the book as well. It's about networking, telling people what you want. And the more specificity that you give to those details, the more that there's opportunities for people to share with what you want. So I used that illustration earlier of I want a good deal. Well, what's that mean? What's a good deal to you? Well, then if I say I'm looking for 50 to 125 key roadside motels and hotels that are mom and pop operated in leisure-oriented markets within 3 hours of a MSA, and you start getting more granular in the detail, and you go show that to a broker and to a network meetup and to other investors. When that actually comes in, it's very easy to define. I've said, this is what a good deal is for me. I can then go share that out to other people, and then they sometimes it'll find its way back to me. Or I'm very proactive in this, is we're sending out a certain amount of mailers. We're calling people. We're looking at establishing as here's this market. We research every single property in that particular city that hits our criteria that we're interested in. And then we start figuring out which ones are an opportunity to purchase, because maybe it's an out-of-state buyer or owner. Maybe they've held it for 10 years. If they're a private equity fund or institutional investor and it's in year 10, they're probably looking to liquidate to realize their gains. And so there's different qualities that you can start doing in your research on a particular market, that you can be both proactive, outreaching, outbound calls, as well as adding specificity towards what you're looking for. Then other people will have the ability to help send those deals to you. And then it's just networking, and it's just old school, making calls, getting to, investor conferences, getting out there. And then each one of those, I think, or collectively, the totality of them leads to finding some deals.
When you say specificity and what you're looking for, what do you tell brokers specifically that you're looking for so they know what to send you?
So right now, like I was kind of giving you the illustration, is I think opportunities in hospitality right now. I think there is going to be not necessarily distress in the traditional sense of distress, but there is opportunity to structure a deal that's beneficial. Meaning, these are 8, 10 cap properties right now. And we have some kind of systematic way in which we think we can 2 to 4x the NOI in the course of a year. And then obviously that will take the valuations significantly up, again, to 2 to 4x in the value by driving those NOI values. And so when I give them specificity, that 50 to 125 key in a roadside motel hotel, so a Super 8, a Days Inn, a Best Western, a Motel 6, a Travel Lodge. These are kind of the product type that we're looking for. We're looking in markets like Asheville. We're looking in Steamboat Springs, Santa Fe, New Mexico, Tahoe, a combination of a couple of these other areas. And so to give you a little bit more data analytics, within 3 hours of a major metropolitan area. So Charlotte, Raleigh, Chattanooga, Nashville, Atlanta, each one of those is a major metropolitan area. Take 3-hour radiuses, and then a leisure-oriented market, meaning historically it's been a leisure-oriented market. So it's Myrtle Beach or Hilton Head or the national parks or a national forest, something along those lines that's historically drawn people to that destination in the past. And because there is, again, my investment thesis and methodology is that people are going to start doing more roadside road trips. We've seen this in an uptick in RV sales pretty significantly. RV parks are kind of very, very full. And so even though gas is more expensive, what the avatar that we're after is, we call them Tesla Ted. Tesla Ted drives a Tesla. They will drive, 100, 200 miles to a destination. And especially in some of these metropolitan areas that have seen a significant uptick in population over the last 5 to 10 years, people in those new areas from California or New York or Washington that have moved to Tennessee or the Carolinas or Texas are going to then drive to some of these locations to go check them out to see what they are, because they've now seen them or they're just new to that market. That uptick in population, we believe, is also going to lead to an uptick in the market fundamentals of roadside travel. And then what we're trying to do is disconnect from the Super 8, Best Western, race to the bottom price point. And then we're targeting someone that will pay $139 to $159 a night on that same product type, but we're going to have to spend a little bit more CapEx to do that.
What advice do you have for our listeners in keeping an eye out for distressed properties? And do you have any forecasts as to what you expect for 2022? Because as we're recording this, May 31st, the stock market is tanking. Interest rates have shot up dramatically over the past month or two, and the housing market is cooling off slightly. What do you see coming up for the rest of 2022? And what would you tell our listeners to do to position themselves?
Here's my opinion on what I believe is going to happen with the remainder of 2022 is it'll be announced, and maybe by the time the show airs, is we will be in a recession by a technical definition of 2 quarters of negative GDP or declining GDP. And so we will be in a recession. The fact that the Fed jacked up rates pretty significantly and aggressively also increased that. And so I look at some things like the ports, the rail car loading, and demand has definitely fallen off in a lot of areas from the residential consumer. And so when we look at that, is by technical measures, the stock market, cryptocurrency, anything that had kind of financial manipulation to it was overinflated. There was a significant sell-off. And I think some of that has been oversold. We'll maybe have a little bit more sell-off and some pain in that market. So the Fed will not raise rates as much as they were talking. They're going to continue to kind of talk tough because that's what they wanted to do, was curb this inflation. I believe we're past peak inflation prices already. Normalizing of supply chains and logistics is already happening. It was the kind of pandemic lack and then a huge swing to a bunch of demand all trying to get done at once. So I think prices are going to start coming down. The inflationary pressures are going to start coming down. And we are going to be in, again, a technical recession. By the end of Q3, Q4, they'll actually start talking about lowering interest rates. Because that, and part of the reason that, in my opinion, that they raised them so fast was it gave them other kind of mechanisms to manipulate the economy. And when rates were at zero, they had nothing they could do other than go, like in Europe or Japan, to a negative interest environment, and they don't want to do that. So they raised it as fast as they possibly could, so then they can then take that down 25 bips or another 25 bips, and it can kind of start normalizing. But we're in a, continuous QE money printing cycle from the United States and really the world over. The United States is financially the tallest midget. We're not doing anything that great, but everywhere else kind of sucks worse. Europe is in pretty bad shape. China, with its lockdowns and some of the commodity prices, is affecting it. The labor is very expensive there. Ukraine, Russia, political war type things are going to continue to put a lot of pressure on that part of the world as well. So when I look at this, is everyone else, economically is struggling. That doesn't mean that the United States is doing anything a lot better. It's just, like I said, we're sucking less, and so then subsequently there will be a pull down and they'll start talking about printing money again. And I say in the next 12 to 24 months, that'll happen. I think it'll start because the Fed and the government only has a couple of mechanisms of tools that they can do. They can raise rates, keep the rates the same or lower, or they can do QE and buy and print money. And so them raising rates, we're going to see pricing, and I say pricing of extraneously expensive things like board foot of a lumber was up at $1,700. Now it's back down to $700. And going down, that is the stuff that's normalizing. From a real estate perspective, I think we're going to have a slower growth. We had a crazy uptick in values over the last couple of years. There's inventory that's slightly up, but there's way more buyers that exist than there is inventory. So I think pricing is still going to move up. There's more renters. We're undersupplied on the amount of residential units across the country. But that's not holistically saying that everywhere is going to be okay. There's some markets that have had declining populations, and they may see some pullback in some pricing and some downturn. So like real estate, they say location, location, location. All that does matter is where are you? What are you investing into? And there's certain asset types that are going to maybe struggle more than some of the residential related, multifamily, build to rent, single family rentals and houses. In general, I think those are going to hold up pretty well.
How would someone find out more about you and or get a hold of you? And please plug your book as well.
Catchknives.com. That's with an S. Catchknives.com is where you can sign up to get part of our newsletter. I do offer some courses. I've had some people reach out and ask to help guide them in the due diligence process. And so I've done that to help guide some people there. You can buy the book through the website. You can find it on Amazon, Barnes & Noble, a couple other online bookstores. Again, I don't think very many people carry physical books unless you're like top New York Times bestseller. It was an Amazon bestseller, but not a New York Times bestseller. So catchknives.com. You can find me personally on social media at jake.realestate. Instagram is where I'm most active. And oftentimes, if you just search Jake Harris Real Estate, that'll pull up to a YouTube channel, LinkedIn, and other areas. I don't think I have a Twitter. I might have a Twitter, but I don't maintain that very much, or maybe my team handles that. But Instagram is where I'm most active in the social media space. Then obviously through the website is you can get to subscribe to our newsletter where we share some of these insights as well as some of the deals that we're doing.
Thanks so much for coming on the show today to discuss distressed commercial real estate. It's been a pleasure talking with you and hearing some of your examples, as well as your outlook on the current economic situation and kind of what you see for the rest of 2022. Thanks so much for having this conversation with us today.
Appreciate it. Thank you, Brian.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB & Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.